Have you ever, paused in the middle of the grocery store, holding a bag of your absolute favorite snack, and actually wondered who invents that exact craveable taste,
Oh, totally. We all do that.
right? Or when you're at the fragrance counter, you know, who is out there designing the precise microscopic molecules that make a luxury perfume smell like a spring morning after the rain?
Yeah, we always picture some like lone genius chef or a master perfumer in a Parisian boutique just mixing vials.
Exactly. There is this incredibly romanticized artistic expectation when it comes to our senses.
We really want to believe it's pure magic happening in a sunlit studio somewhere.
But, well, the reality is often much more industrial. And we've got our hands on a fascinating document today for this deep
What
dive.
do we do?
It's a Q1 2026 earnings report and the executive call transcript from May 5th and 6th, 2026 for a company called International Flavors and Fragrances, or IFF.
An absolute giant that no one really knows about.
No. Right. So by stripping away the marketing PR and looking directly at these executive conversations, we are going to expose the mechanics behind the curtain. We're looking at a massive, invisible B2B giant that operates entirely in the background.
Yeah, but their products end up in virtually every aisle of your supermarket and every cabinet in your bathroom.
It's wild. The mission of our deep dive today is to explore how a multi-billion-dollar corporate behemoth like this actually operates. Like, how do you even quantify taste and smell?
And most importantly, how massive global forces, from cutting-edge biotech innovations to geopolitical supply chain shocks, eventually show up in the price of the products you use every single day.
We are basically slamming the sensory right into the cold, hard numbers.
That's the perfect way to put it.
And, the numbers coming out of this highly unpredictable global environment are pretty surprising.
Yeah.
I mean, the macroeconomy is undeniably tight right now. So how did IFF actually perform this quarter?
Honestly, they put up numbers that shocked Wall Street.
Wait, really? How good were they?
Well, for the first quarter of 2026, IFF hit $2.74 billion in actual revenue.
Wow.
Yeah, that beat expectations by nearly $100 million. And their earnings per share came in at $1.25, which easily beat the $0.08 consensus.
Okay, those are huge numbers.
Right. And their adjusted operating EBITDA, which is basically, a measure of their pure cash profit from daily operations, it hit $568 million.
Pushing their margins up, right?
Exactly. That expands their profit margin to 20.7%.
Okay, those are massive figures for an environment where consumers are supposedly pulling back. What's driving that?
Yeah.
Because over the last couple of years, when companies posted big revenue beats, it was usually a bit of a mirage.
Oh, you mean the inflation trick?
Yeah, exactly. Inflation went up, companies hiked their prices, so revenues looked bigger even if they were selling fewer physical goods.
Right. But what's fascinating here is that this beat was not a fluke of pricing. The executive specifically pointed out that this growth was driven by actual volume increases.
Wait, volume, like actual physical stuff?
Yes. Across all four of their business segments, health and biosciences, taste, food ingredients, and scent, they literally manufactured and sold more physical product,
That's insane.
achieving real volume growth across every single division simultaneously in a cautious macroeconomic environment is incredibly difficult. It really proves the essential nature of their business.
It almost feels like they are the Intel inside of the beauty counter or the snack aisle.
Oh, I like that analogy.
Right, because you don't buy a computer just to look at the microchip, you buy it for what the chip does.
Mm-hmm.
Similarly, you don't go to the store to buy a bottle of IFF body wash.
No, nobody does that.
But if their invisible operating system, the scent or the flavor fails, the entire consumer product fails. So even when consumer demand gets wobbly, those major brands just cannot afford to stop buying their core sensory ingredients from IFF.
That is spot on. If you think of them as the essential architecture of the consumer goods world, you realize a big top-line revenue number is really only the surface layer of the story.
Yeah, there's always more under the hood.
Exactly. To understand how a company of this scale is navigating 2026, we have to look at what they're actively choosing to build and, well, perhaps more tellingly, what they're choosing to throw overboard.
Right, because they are aggressively trimming the fat right now through what they call portfolio simplification.
Yeah, they really are.
The report details the recent sale of their commodity soy crush, concentrates, and lecithin business. They sold it to Bunge for $110 million. Just snipped it right out of the portfolio.
And to understand why, we need to look at what soy crush actually is.
Okay, what is it? Because it sounds incredibly unglamorous.
It really is. It is essentially taking raw soybeans and mechanically crushing them to extract oil and meal. It's a heavy, volume-based, low-margin commodity business.
So it's just moving massive amounts of crop.
Exactly. It doesn't require the high-end, microscopic scientific engineering that IFF wants to be known for. So they sell it to a massive agriculture giant like Bunge, who specializes in that exact bulk infrastructure, and IFF just pockets the cash.
Okay, that makes perfect logical
Yeah,
sense.
yeah.
Get rid of the heavy lifting. But then we get to the food ingredients segment, and things get a little weird.
Yeah,
They are actively running a disciplined sale process to divest their entire food ingredients segment. They promised an update by Q2.
right.
But earlier in the exact same earnings call, they bragged about how incredibly well this specific segment is performing.
Oh, it's doing phenomenally well.
Okay, let's unpack this.
Yeah.
It posted double-digit EBITDA growth. Its margins have steadily climbed from 9% in 2023 to an expected 14% this year. And the volume growth just hit 5%, which is the highest in years.
Yep.
If you have a business unit firing on all cylinders like that, why on earth do you put a for sale sign on the front lawn?
I know, it seems entirely counterintuitive, but it gets to the heart of modern corporate strategy. A company's management attention, its scientific brainpower, and its capital. They're strictly finite resources, and they are most valuable when fiercely concentrated on your core identity. Food ingredients is doing brilliantly right now, but by selling a highly polished, high-performing asset, IFF can demand an absolute premium from buyers in the open market.
Ah, so you don't list your house for sale when the roof is caving in and the basement is flooded.
Definitely not.
You sell it right after you've remodeled the kitchen, the paint is fresh, and the housing market is red hot.
Exactly. And what you do with that premium dictates your future. They are channeling that cash into two specific buckets. First, debt reduction.
Right, which is huge right now.
Massive. They've already reduced their gross debt by over $3 billion year over year. That brings their leverage down to 2.5 times.
Meaning what for the listener who isn't a finance nerd?
In simple terms, for every dollar of cash profit they generate in a year, they now only owe $2.5 of total debt. By corporate finance standards, that creates a massive financial fortress. You just aren't constantly stressed about making interest payments.
Got it. And the second bucket is reinvestment, right? They aren't just hoarding the cash, they're building actual physical infrastructure.
Yes. The call highlighted their expansion in Latin America, specifically.
Oh, right, opening a brand new fermentation-based enzyme production site in Arroyo, Argentina, and a new household care laboratory in Brazil.
Which is a massive technological pivot. I mean, they are abandoning low-margin agricultural commodities to pour resources into highly specialized biotechnology.
Let's actually pause on that, because fermentation-based enzyme production sounds like a phrase that requires like a PhD in biology. What are they actually doing in that facility in Argentina?
Well, instead of growing a plant in a field, waiting for it to mature, harvesting it, and extracting a chemical from it.
Which takes months or years.
Right. Instead of all that, they are operating at the microscopic level. They take specific microbes, like specialized yeast or bacteria, they put them in massive steel vats, and they feed them sugars.
Okay, so it's like a brewery.
Exactly like a brewery. They have essentially programmed these microbes to brew the exact chemical compounds, the specific enzymes or flavors they need, almost the same way a brewery uses yeast to ferment beer.
That is wild.
It is highly engineered, completely controlled, and entirely independent of weather patterns.
So they are retreating into the lab to build a fortress of proprietary high-margin tech. But, taking shelter in the lab implies there is a storm outside.
Oh, there is a massive storm outside.
Yeah, and if you look at their scent division, it's clear they are getting severely battered by the weather right now.
The scent division is the perfect case study for this transition. Overall, the segment managed to grow by 1%.
Barely.
Right. And it was heavily propped up by strong performances in fine fragrance, which goes into high-end luxury perfumes and consumer fragrance, the scents used in detergents and soaps.
Right.
But dragging that entire division down is a specific subunit called fragrance ingredients.
Yeah, the CEO, Eric Fairwald, specifically called this unit out on the call. He said this ingredients business makes up about $500 million in outside sales.
Yeah.
He noted that half of that is specialty ingredients, which are doing great, but the other half is commodity ingredients. And that commodity half is just bleeding.
Because they are facing a brutal mathematical trap, The raw materials required to make these basic foundational scent commodities are getting more expensive. But IFF cannot raise the prices of their finished
Why
commodities
not? If their costs go up, shouldn't they just charge more?
because they are facing fierce, cutthroat price competition from massive chemical producers in India and China.
Ah, it's a race to the bottom on price.
Hmm?
If you raise your price by a penny, the buyer just calls a factory in Asia.
Exactly.
So how does a legacy Western company fight back when they can't possibly win a price war?
Well, you change the rules of the game,
Yeah.
and their strategic shift here is ruthless.
What are they doing?
They are going to continue producing these commodity ingredients, but predominantly for their own internal use.
Oh, okay.
Yeah, they still need these basic chemical building blocks as the foundation for their own complex high-margin formulas, but they are actively going to stop hustling to sell these basic commodities to external buyers.
Wow. Just dropping the external sales completely.
Basically, instead, their external sales team is pivoting entirely toward those high-margin specialties, the naturals, the synthetics, and those biotech molecules we just talked about.
Because a proprietary biotech molecule
Uh-huh.
cannot be easily copied and undercut by a generic competitor overseas.
Exactly.
You have the patent, you have the custom microbe, you control the supply. The executives on the call noted they have an 18 to 24-month research and development pipeline churning out these new lab-created molecules right now.
And if we connect this to the bigger picture, that innovation is the only way to escape the global supply chain meat grinder.
You can't out-cheap them, so you out-innovate them.
That's it. That pipeline is exactly what protects their profit margins going into 2027.
Which raises a huge question for you, the listener tuning in. Does this mean the everyday consumer will eventually be buying luxury perfumes made of lab-grown biotech molecules rather than traditional natural ingredients like actual crushed rose petals or real vanilla bean just because of global B2B price wars?
You absolutely will be, and honestly, in many cases, you already are.
Wait, really? Already?
Oh, yeah. But it's crucial to understand it isn't solely about outmaneuvering a price war. Lab-grown biotech molecules offer something agriculture can never promise, and that's absolute consistency.
Okay, give me an example.
Think about vanilla. A drought or severe storm in Madagascar can devastate a vanilla crop, spiking global prices overnight and actually changing the subtle flavor profile of the beans that do survive.
Because the soil and weather were different.
Right. But a bioreactor in Argentina feeding sugar to microbes produces the exact same yield with the precise same microscopic flavor profile every single time.
So the scent of a spring morning is increasingly manufactured in a steel vat to avoid climate risk and foreign competition. That is wild.
It really is a massive shift.
But, while the Chinese and Indian competition is a slow-burning strategic challenge they can solve over a few years with biotech, the earnings call revealed a much more immediate physical crisis hitting IFF's supply chains right this second.
Oh, yeah. This was the major plot twist of the presentation. After laying out all these incredible Q1 victories we just talked about, management specifically warned investors that Q2 EBITDA will actually be lower than Q1.
They are facing a guaranteed dip, and they know it.
Yes.
And the culprit is the ongoing geopolitical conflict in the Middle East. And it's vital to state here that we are strictly looking at the mechanical, economic, and supply chain impacts as reported by IFS executives on this call.
Absolutely.
We aren't taking a political stance. We are just mapping the ripple effects on global trade based on their transcript. And the disruptions they describe are massive.
They really are. The conflict hits a manufacturing business like IFF in two distinct mechanical ways.
Okay, what's the first?
First is the macroeconomic level. The instability is driving up the price of Brent crude oil. Because IFF manufactures physical heavy goods and ships them globally, a spike in oil prices instantly spikes their energy and logistics costs.
Just to move the goods.
Right. They are already dealing with double-digit percentage increases just to keep the lights on and the trucks moving.
And the second impact is almost bizarrely physical. It's not just the fluctuating cost of fuel, it's the physical reality of getting a cardboard box into a port.
Yes, this part blew my mind.
They highlighted that their customers are literally unable to get physical packaging into the Middle East for fine fragrances.
It creates a domino effect. If a luxury brand cannot get the empty glass bottles, the spray nozzles, and the custom cardboard boxes delivered to their factory because shipping lanes are disrupted.
They have nothing to put the perfume in.
Exactly. And if they have no bottles, they stop buying the liquid fragrance from IFF.
Yeah.
The entire volume stalls completely, not because no one wants to buy perfume, but because the glass is stuck on a ship somewhere.
It's a textbook example of how incredibly fragile our global supply chains still are.
Yeah.
And it forces IFF to react.
Yeah.
They have to pass these newly inflated shipping and energy costs onto their customers. But in the B2B world, inflation doesn't happen overnight, does it?
No, there's a mechanical lag.
Right.
Exactly. When a grocery store's costs go up, a manager just walks down the aisle with a label gun and raises the price of milk that afternoon.
Done.
But in B2B, contracts are sticky. They are locked in for months or even years. IFF is rolling out what they call logistics and energy surcharges right now, but they estimate it will take 12 to 18 months to fully pass the rising cost of raw materials through the system and into final renewed contracts.
So what does this all mean for the listener? It basically explains so much about inflation. It means the price tag on that luxury cologne or that high-end laundry detergent you buy next year is actually a delayed reaction to the cost of global oil and geopolitical shipping disruptions happening right now, today.
You are always paying for yesterday's headlines.
That's exactly it.
And what is particularly interesting is the tone IFF's management took when discussing these necessary price hikes with Wall Street analysts. The CFO emphasized that they are not using this crisis as an excuse to price gouge or artificially inflate their profit margins.
They're trying to build trust.
Right. They go to their corporate customers with the raw data, the undeniable rise in logistics costs, and essentially say, look, we are only passing through the actual pain we are experiencing.
And they're even offering a pressure valve, right?
Yeah.
Like if a specific natural ingredient is suddenly too expensive because of a shipping lane conflict, IFF's scientists actually work with the client to reformulate the product.
Yep. They try to find a cheaper, perhaps synthetic or biotech alternative that smells or tastes identical, just to protect their client's bottom line.
Which perfectly ties back into their massive investment in biotech and synthetic molecules. It's a huge competitive advantage if your scientists can literally engineer a chemical bypass around a global supply chain bottleneck.
It's brilliant.
But considering all of this, knowing that Q2 is going to take a profit hit, knowing inflation is spiking, knowing conflicts are disrupting their physical shipments, how can IFF's management be so remarkably optimistic about the rest of the year?
It's surprising, isn't it?
Yeah. I mean, they didn't back down on their annual financial projections at all.
They held incredibly firm. Despite the explicit warning about Q2, they confidently reaffirmed their full-year 2026 guidance. They are still telling investors to expect $10.5 billion to $10.8 billion in sales and $2.05 billion to $2.15 billion in adjusted EBITDA.
That requires some serious nerve. Where does that confidence come from? Because you don't promise Wall Street $10 billion unless you have a very solid safety net.
Well, that safety net is their absolute laser focus on cash generation and internal productivity.
Okay, let's look at the cash first.
In Q1, they generated $92 million in free cash flow. That is a massive $144 million improvement compared to the same time last year.
That's a huge swing.
It is. And to ensure the entire massive corporation stays focused on this metric, they made a brilliant administrative move. They actually tied employee incentive compensation directly to free cash flow conversion.
I noticed that detail. If you want to change the culture of a massive corporation, you just change the math on how people get their bonuses.
It works every time.
But what does free cash flow conversion actually mean for the employees on the ground?
In simple terms, it means you don't get your bonus just because the company sold a lot of product on paper. You get your bonus when the company actually collects the cash and has it sitting in the bank free and clear of operating expenses.
Oh, wow. So you have to actually secure the bag.
Exactly. Suddenly, every manager in every division is looking for ways to collect invoices faster, manage warehouse inventory tighter, and streamline their daily operations to free up cash.
And why does a listener care about a corporate supplier's cash flow? Because if a massive invisible monopoly like IFF has terrible cash flow and starts panicking about debt, they aggressively hike prices across the board. That cascades down the chain, and suddenly your favorite snack or soap jumps in price by 20%. Operational resilience at the B2B level prevents wild price swings on the grocery store shelf.
Exactly. It drives structural stability for everyone. And the second reason for their confidence is just the timeline of the year. They know Q2 will be rough, but by the third and fourth quarters, those 12 to 18-month pricing surcharges we talked about will finally catch up to the inflation curve.
Ah, so their margins will recover naturally.
Right. Furthermore, that heavily funded R&D pipeline we discussed is slated to start delivering major new product wins in the second half of the year.
Right. They expect a turnaround in North American health trends to accelerate from the back half of this year straight into 2027.
Yes.
Looking at the whole picture, it really is a masterclass in executive management. It's a lesson on how to navigate chaos. You ruthlessly control the variables you actually own, your internal cash flow, paying down your debt, investing heavily in your own scientific patents, and aligning your employees' bonuses to efficiency.
Because you have to.
Right? You do all of this precisely because the macro environment, the inflation, the shifting consumer habits, the global conflicts are completely out of your hands.
You build a ship strong enough to weather the storm rather than just hoping the ocean miraculously stays calm.
That's a great way to put it. So let's briefly recap the journey we've been on today. We started by looking at a massive, invisible B2B giant, the quiet architect of our grocery and beauty aisles, pulling off a multi-billion-dollar earnings beat against the odds.
Quite the feat.
We explored how they are strategically selling off heavy agricultural businesses like Soy Crush and highly profitable food divisions just to build a financial fortress and reinvest in the microscopic core.
The biotech pivot.
Exactly. We saw how fierce price wars in Asia are forcing them to abandon simple commodity fragrances in favor of high-tech, lab-grown biotech molecules. And we tracked the mechanics of how a shipping disruption in the Middle East stalls empty glass bottles, creating a delayed price hike that hits your wallet a year later.
It reveals the profound interconnectedness of the modern economy. A microbe fermenting in an Argentine steel vat, a price war in India, and shipping delays in the Middle East all converge to dictate the financial strategy of a boardroom in New York.
And ultimately, the physical product sitting in your home.
Exactly.
It is incredible. And it leaves me with one final, slightly provocative thought to end on today. Something that wasn't explicitly debated on the earnings call, but feels like the unspoken undercurrent of everything we've uncovered about their pivot to biotechnology.
Oh, I like where this is going.
If companies like IFF are actively moving away from traditional agricultural commodities because they are too vulnerable to climate change, too fragile in a supply chain shock, and too easily copied by overseas competitors, and they're moving toward highly engineered proprietary synthetics to protect their margins. What does the future of the word natural actually mean?
Oh, wow. Yeah. It is a paradigm shift in how we define authenticity. We are completely rewriting how we source human sensory experiences.
In 10 years, will the most authentic, the most sustainable, and the most reliable flavors and fragrances, the ones that perfectly capture the essence of a spring morning or the craveable hit of a snack, be the ones brewed by programmed microbes in a sterile bioreactor rather than harvested from the unpredictable earth?
It's highly likely.
When the romantic magic of the senses collides with the brutal reality of the balance sheet, the laboratory might permanently replace the farm. Think about that the next time you spritz your favorite perfume. Thanks for joining us on this deep dive. We'll catch you next time.